Good morning. Thank you so much for joining us today as we present to you cash books and annual statements. Today's webinar is being recorded. It will be available at a later date on our website. Board members attending this live event will automatically receive their 3 credits in Prosper. You should see the credits within 1 week in your accounts. Joining us today to present is Scott Henderson, PARAC's Deputy Chief Auditor, Sarita Yee, Senior Investment Analyst, and Karen Shea, our Director of Audits. Questions. If you have any questions throughout the presentation, please type them in the questions field in the GoToWebinar control panel rather. And if you would like to download the presentation and sample annual statements, there is a download tab, a handouts tab that you can click on, and there you can click on the 3 downloadable handouts. You do need to download them during the presentation, otherwise they will not be available until we post them to the website. And again, questions, there will be breaks throughout the presentation to answer questions, but as you think of them, just type them in to the panel. So to start us off is Karen Shea, our Director of Audits. So I will turn it over to you guys and turn off my cam. Thank you.
Thank you, Natasha. Good morning and welcome to today's webinar. I'm glad you could join us, and I'm confident you'll leave today with a better understanding of the cash book analysis process and the ins and outs of preparing your annual statement. Before I pass you on to the heavy hitters, Sarita and Scott, I'd like to give you a quick update on what the audit unit has been up to, and I'll show you the results of the audits performed over the last few years. Next slide. So when we first got the stay-at-home order, when it first went into effect, we tried to get as much information as we could electronically, scanned in documents, things like that, so we could keep the audits moving and work from home then. But there came a point where we needed to review things on site, like member files, invoices, things like that. So when we came to a halt on that, we started reviewing the annual statements as they came in last year. So many of you have probably heard from one of the auditors. You probably received an email with questions regarding information in your annual statement. I'm not going to go into too much detail on that now because Scott has included that in his part of the presentation. So once we went through all the annual statements, we started new audits remotely, and this took, a lot of the administrators sent us electronic information through Interchange, which was very helpful. We could do quite a bit of the audit steps from home, and then there were some steps that we can't do from home, so we would have to do them. We'd have to go on site. We went on site periodically, sometimes 1, sometimes 2 days a week, whatever we could do when the boards were open. And most of our correspondence was obviously through email and phone calls. We also started working on follow-up audits remotely. So back in, you can go to the next slide. Back in 2016, I gave a presentation on audit issues that PARAC was finding at that time. I thought it was important for all boards to know what the issues were and that they were a lot of boards with the same issues. I included a chart of the audit showing the audit findings broken into 7 categories, and it's been a while since then, so I thought I'd give you a quick update on that. On the next slide, I'll show you a chart with the results of the 65 audits that have been completed in the last few years. For comparison purposes, I include the results from my previous presentation. So 23 of the 65 audits, 23 of them had no findings at all. The remaining 42 contained at least 1 finding, and many had multiple findings. In total, there are 113 findings, and you'll see in the chart, as you can see. They're broken down into 10 categories. 3 more categories have been added since the last presentation. Okay, so as you can see in the chart, the last time it was reported, the majority of the findings had to do with regular compensation and members' contributions. Currently, those 2 areas have decreased and are only 15% of the total findings. The findings that have increased are the retiree calculations, went from 6 findings to 15, board governance from 11 to 14, cash reconciliations doubled, went from 5 to 10, expenses went from 6 to 8, and the 3 new categories that we added, investments, that was part of the other presentation, but it was part of the other category because there were only 2 findings. That went up to 11 findings. And service purchases and accounts receivable had no findings in the last go around, and the service purchase, now we've had 9, and accounts receivable 4. There are a couple categories I'd like to point out. Next slide. Is board governance. Previously, we were reporting on low attendance, minutes not being signed, or not being approved, and not reviewing monthly cash book packages. The monthly cash book packages is still part of the issues, but we're finding now they're missing minutes. Either they're not, weren't recorded, or they've been misplaced, or they were just not available. No executive session minutes, same thing. We can see that the board has gone into executive session, but we don't see any minutes on it. And then there were a couple where monthly meetings were not held, and I think one was a snowstorm, and I think one where they didn't have a quorum. These should be rescheduled if that happens. Next slide. And the other area I'd like to point out is the expenses and the credit cards. I'm not sure if everyone knows, but there is a regulation for credit cards. It's within the PERAC travel regulations, and it's 840 CMR 211. It's basically, credit cards are basically for travel-related expenses. And specifically, 840 211.2 states credit cards issued to the board are not to be used to purchase supplies or other items that the board staff use at a regular basis, in which can be readily anticipated and purchased by way of a competitive process. The last couple of years, we have been noticing the boards are using credit cards, and they're using them for purposes outside of what the regulation allows. Lastly, next slide, the other category, some of the examples in the other category, they include 91A over earners, 38C billings, refunds, retiree affidavits, pension appropriations, and membership member files. So all of these audit reports can be viewed on our website if you want to read through some of the different findings. But that's my quick overview. Now I'll turn it over to Sarita, who'll be giving an overview on the cash book process. Thank you.
Thanks, Karen. Good morning, everyone, and welcome to today's cash book overview. I want to extend the thanks for joining today's session. My name is Sarita Yi, and I'm the Senior Investment Analyst here at PERAC. In today's overview, we'll be it'll be divided into 3 separate sections. We'll be going over the reporting components and requirements of the cash books, what we do here at PERAC once we receive your cash books, and then finally, we'll be touching upon some tips and recommended accounting practices and practices to avoid. As Natasha mentioned, if you have any questions during the presentation, please feel free to type them into the chat window. And I will be stopping in between each section to address any questions. There will also be a main question section if we don't get to address your questions in between each section. Before we kick things off, we're going to have a poll question, just kind of to get to know the audience, today's audience. And Natasha is going to launch the poll question. How many years experience have you had processing cash books? A, less than 3 years, B, 3 to 8 years, or C, over 8 years. If you're a board member attending today's class, please feel free to choose the first option.
Okay, we're going to leave it open about 5 more seconds. It looks like the majority of you have chimed in. Great, thank you.
Wow, the majority is less than 3 years. Great. I myself have been at PARAC for just a little over 2 years, so I would also fall into that first category as well. Welcome, everyone. So reporting components and requirements. This section will mainly address regulations detailed out in 840 CMR 4. And so we'll kick things off with the monthly cash book package, which is we oftentimes will refer to as the standard package. So what does this consist of? It consists of a year-to-date trial balance report and month-to-date date range for your cash receipts, cash disbursements, adjustments, and general ledger reports. Sometimes these month-to-date reports will also be referred to as your activity reports as they detail out the activity posted. I do want to note here that the general ledger is a new report that was added onto this list effective in 2019.
Whoops, sorry about that.
No problem. Just an example of the date ranges for September would be January 1st through September 30th for your year-to-date trial balance, and September 1st through September 30th for your month-to-date activity reports. Now, in any given month, January through November, the standard package is what PARAC will be expecting. However, December is a little bit different, and we require 2 sets of reports from the boards. First set will be your pre-close books. Essentially, this is before you apply your closing entries, and they will consist of your regular monthly entries, but also include any year-end accruals and adjusting entries. Essentially, it's everything up until but before you apply your closing entries. And Scott will kind of go over year-end processing and closing entries a little bit more during his presentation. After you've applied all your year-end accruals and adjusting entries, you'll want to run your reports, your trial balance, your cash receipts, disbursements, adjustment, general ledger, submit that to PARAC, and then apply your closing entries. Once you've applied your closing entries, you'll want to run a set of post-close books, and this will consist of a year-to-date trial balance and a GL. You don't have to rerun receipts, disbursements, or adjustment reports, as really what we are looking for here is that you have accurately and appropriately closed out your accounts. We'll be looking for your receipt and disbursement accounts. That's essentially your accounts that start with a 4 and 5, that these should be 0 when you submit your post-close trial balance. An important tip here and item to point out is that your pre-close books is really what we'll be looking at as your final December books. And we will be comparing, using the information on that to calculate our performance. to close up the performance for the year, as well as we'll be using your final pre-close books to reconcile back to your annual statement, especially in particular to the assets, liabilities, receipts, and disbursement accounts on the annual statement. Now that we've gone over what the components are of the cash books, next question we'll address are when are they due? The monthly cash book packages are due within 4 weeks of the close of each month. Starting in 2019, we also started to send out cash book reminder notices. So below is I'll kind of outline the process for that. The first notice will usually be sent out if the boards are 45 days late or past due with their cash books. An email will be sent to the cash book preparer and the admin. If the boards are 60 days late with no response to the first notice, a second notice will be emailed out to the chair and admin. And finally, if after 90 days and no response to either first or second notice, a suspension notice will be issued in the form of a physical letter to the chair. The board member and the admin will also be CC'd on this letter. Again, these dates are approximate. We found that after we've started this process, it has improved with the timeliness of our cash books. Next, in accordance with A40 CMR4, kind of be going over some additional components related to the cash books. These consist of pool fund worksheets or investment manager statements. These are essentially statements that the board should be receiving that detail out any transactions, disbursements, capital calls, asset value changes, and fees related to their investments. Along with this are custodian reports and consultant statements, should the boards also have these, if applicable to the boards. Pool fund statements and investment manager statements should be received on a quarterly or monthly or quarterly basis. Custodian statements will also be received on a monthly basis, consultant statements on a quarterly basis. It is the board's responsibility to send or have sent to PERAC a copy of all of these financial statements within 4 weeks of receiving them. The next topic we'll address is how should we submit this information to PERAC. The monthly cash book packages can be emailed to PER Cashbooks at per.state.ma.us. Please note that this email address is a no reply address. So if you have any questions or concerns in the email you send to us, please be sure to CC the PERAC investment analyst as well, either myself or Veronica. That way we can get back to your questions or concerns in a timely fashion. For manager statements, custodian reports, and consultant reports, these should be sent directly to your PERAC investment analyst and should not be emailed to the PER cash books. That email address has been designated to receive cash books only. And should you feel that you need to fill out a pool fund worksheet instead of sending PERAC the investment manager statements, the pool fund worksheets can be filled out online at the address provided. Next slide. And that covers the reporting components and requirements of the cash books. Before we go into what we do here once we receive them, are there any questions on the requirements?
I have a couple of questions for you, Sarita.
Sure.
So the first one is PERAC current with the notices to the boards? And that,
Yes.
you know.
In terms of the late letter or reminder notices, I'm assuming?
Yes, I believe so. That's when
Yes.
the question came in. Okay.
We do a little bit of a pause after, because year end there is, we understand that there is a little bit of time for boards to finish their December books and closing out the year before they can start with the new year. So the first quarter, we usually give it a little bit of time, and therefore those dates are approximate.
Okay, great, thank you. Next question is, when submitting the December cash books, we originally had until February 28th to do so. Has that changed?
I don't know if Karen wants to chime in here.
I don't think it has. I know, like Sarita was just saying, you need some extra time because it's the year end. So that's kind of what she was meaning, is in this time frame, you're not going to get a notice saying your Decembers are late. Well, you'll get one soon, but after this month.
I think the caveat to that, the late letters and our approximate dates are for the December timeframe. If you are a PRIT-only board, we'll kind of be sticking to that end of February, beginning of March timeframe that we should be expecting your final December cash books. However, if you are a board that has multiple pool fund holdings, some alternative investments that have delayed distribution of statements or separate managed accounts, we give a little bit more understanding and we give a little bit more time.
Okay, and as a follow-up to that first question, the individual said yes in terms of the late letter, so you answered it correctly.
Great.
And then the last question for this section is, what date was the general ledger required to be included with the monthly cash books?
It started off with Memo 16 in 2019. I think that went out around the July 19th timeframe.
Okay, and that was the last question for this section.
Okay,
but
great.
Audience, feel free to continue submitting questions and we will answer as many as we can throughout this session. Thank you.
Okay, so going on to the next section, what do we do with the cash books once we receive them? Now, the first thing that we do is we ensure that the monthly cash book submissions and the reports included in that submission are complete and continuous. What does this mean? I'll go over what this means in further detail in the next slide, but essentially it just ensures to us, it's a check that we perform, just to ensure that reports included in that submission are just fully complete. The activity is continuous from prior month into the current month submitted. Once we've done that check and everything checks out, there's no differences identified there, we continue on and verify the activity within the report. In the report submitted, we verify that any investment related activity is booked to the correct accounts. We also perform a cross comparison of asset values between the trial balance and what the board has recorded on their general ledgers versus what we see in their manager statements, pool fund worksheets, custodian reports, and consultant reports. In addition to this, we also track the proper clearing of any accounts receivables or payables from prior year's Schedule A. And finally, we also take all of this information, track it, and we calculate performance on a monthly, quarterly, and annual basis and benchmark it to their consultants if applicable. On this slide here, we have an example of our trial balance flow check that we do. And essentially here, as we can see here, we've just received the February cash book package. And so what we would do is we would taking where we left off in January of total activity, 7.8 million, we would add to that any activity reported in the cash receipts, disbursements, and adjusting journal entry. Add that to your ending January balance to get to an expected February year-to-date activity total, which is 12.4 million. And as you can see here on the board's February trial balance, they are reporting 12.4 million of activity. So no differences were found, and this is an example of a complete package. On this slide is just a flow chart of the information we receive and how we would use it to cross-compare the assets and activity on the reports. So once we received the manager statements or pool fund worksheets, custodian statement, and consultant statements, in theory, the information and asset values reflected on these reports should be the same. Yes, oftentimes, not oftentimes, but sometimes there will be differences, but these differences really should be attributed to timing differences. If there was a delay in receiving statements, asset value changes for March that reflected on the manager statement might not be recorded on the custodian or consultant statement until April or May. So really, but anything further than 3 months, there shouldn't be any differences that kind of go beyond 3 months for asset value changes and activity. All of 3 of these statements should then be applied to the board's trial balance, and that's what we would also verify when we go through your cash books. And all of this information will go into a spreadsheet that we keep track of on a monthly basis to calculate the performance for the boards. So that's kind of a quick overview of what we do with the cash books once we receive them. I guess before we go on to the next section, are there any questions on what we do?
A couple new questions. Okay, I guess this one's for me. Do we have access to the webinar screens after the webinar? And the answer is yes, we are recording this webinar and we will post it to the website at a later date. You also can download the full presentation, which includes all of the screens. If you go to the handouts tab, you can download a sample annual statement, a blank one and a sample one, as well as a handout of all of the slides. And then the next question is for you, Sarita. Should we send general ledgers back to July if they were not sent?
No, if you haven't included them in your cash book package and we haven't, neither Veronica or I have reached out to you for them, it's fine. If you can just include it going forward, it would be appreciated.
Great, and that was the last question. Thank you.
Okay. I do want to note if they're having trouble, if they're viewing this webinar on a laptop screen and they're having trouble seeing or reading some of the information on some of the images that I have included on the slides, if they want to open up the PDF file, it might be helpful just because in the next couple of slides, I know I bring up images of a trial balance. And so it might be a little bit small if you're viewing this on a laptop or a tablet screen.
Okay, and I have one more follow-up question, Sarita, sorry.
Mm-hmm.
So if
No
you
problem.
look over a system's cash books and something pops as a concern, is the board then contacted? Is it a good thing if we haven't heard anything?
Yes.
Good question.
Yes, that's an excellent question. If you haven't heard from us, that means you guys are doing fine. There haven't been any issues. Right. Not to say that when we reach out to you, it's always a bad thing. But yes, if we haven't reached out to you, it's a safe assumption that there haven't been any differences or variants that we've identified or questions that we have. Okay. Now we'll move on to some recommended accounting practices and some to avoid. So in this section, we'll kind of be addressing a couple things here. In particular, the 2 methods of recording an asset value changes, a consolidated versus multi-entry method. The benefits of using manager statements and custodian statements together to book your asset values. We'll also be discussing the 2 different methods of accounts receivable and payable relief and the benefits of using sub-accounts. Next slide. So here we have an example of, I think it's the next slide, Tasha. Yep. On this screen, we have an example of a multi-entry method here. You can see the board admin is recording changes for the month of August for the PRIT core fund, but however, they've recorded their investment income, management fees, and unrealized and realized losses and gains in 4 separate transactions. Because of the multiple entries, we dubbed it the multi-entry method. Alternatively, on the next slide, we see an example of a consolidated entry in which the board admin has recorded all 4 components of the asset value change for the core fund in one single entry here. Both methods are good methods. However, if there's a preference, we do prefer or recommend that boards use the consolidated method, only because it's less number of entries to get to the same result. One important note here is that when we say consolidating entries, it does not mean netting entries. So in this example here, you can see the board admin is netting together changes for unrealized and realized gains for multiple investments in one transaction with not so great description detail. You can say they're using just an increase to pool funds, more increases, pooled increases, decreases to pool funds. There's no indication what these amounts and what securities these amounts relate to. And because of this, this is definitely a practice that PARAC discourages. Now we'll go through some benefits to using the both investment manager and custodian reports. PARAC recommends that boards compare their investment manager statements with their custodian statements to ensure accuracy when posting monthly or quarterly asset value changes. Entries should never be made solely based on the custodian's report. We've seen in the past that the custodian report will oftentimes net entries, so really any fees, income, unrealized and realized gains and losses will be net into one single entry on the custodian statement for the asset value change. Thus, a reason why boards should not be using the custodian statements to post entries to their general ledgers. Really, the fees, income, unrealized and realized gain losses should be detailed out separately when posting to their own general ledger. As I mentioned previously, when we review the cash books, we also perform the same reconciliation, but the expectation here is that this has already been performed by the board when they're preparing their cash books, and it's kind of checked off before they submit it to PARAC. Next, we'll address the 2 methods of accounts receivable or accounts payable relief, or sometimes we refer to it as clearing. In this example here, it is an example of a single entry method of clearing your receivables and payables from prior year. Here we have this board in particular had some management fees that they had accrued in their payable account in prior year, and in the month of January, they are clearing out that payable. The method they've chosen is just to directly debit out the 2020 accounts payable and credit the cash account, and so thus relieving this payable in one single entry. Alternatively, or we've also seen that some boards have adopted the double entry method on the next slide. And here we see that for this board in January, they are relieving a legal expense that they incurred in previous years. You can see in the detail, it's an invoice from 2018 that they are clearing. However, the entry they've chosen to make is a debit to their legal expense and a credit to their checking account. Essentially, in January, if we are receiving this cash book package, we would almost view this as a current year legal expense or a legal expense that incurred current year. However, in actuality, they had already accrued this legal expense in prior year in their 5308 account. It's not until March you see that they are clearing it out of their payable account. And where they're debiting the 2020 account and crediting the 5308. Because they're really, with the end goal, they're applying 2 entries to get to the same result here. And because of the timing differences, it's possible room for error in terms of there's a delay in reversing the prior year accrual. Sometimes the reversal is forgotten, so therefore they've almost doubled up on their accrual of expenses here and using this example. And just the dual entry method, it leads to backdating, which I'll address a little bit further in the presentation. But because of these possible room for errors, we do recommend to use the single entry method and not to use the double entry method when clearing your receivables and payables. Now we'll move on to the benefits of the use of sub-accounts. If you are a board that is invested in multiple pool funds or have separate managed funds, this is something that's definitely beneficial to you, and they could be created for any account. And it's handy, especially handy, to keep track of fees, income, gains, and losses for specific investments. It's definitely easier if the same sub-account refers to the same investment. So for example, ABC fund or investment company, if you've assigned sub-account 12 to it, to also have sub-account 12 for your income account, unrealized gains and losses, and realized gains and losses. If you have any questions about how to set this up, definitely reach out to your PTG representative and they can assist you in setting up some sub-accounts. On the next slide, I have an example of just a trial balance of a board that utilizes sub-accounts. As you can see here, for their multiple investments in HarborVest, they've just assigned different sub-accounts to it, and it's just an easy way to keep your investments organized on the trial balance, and it's easy to track from month to month any asset value changes and incomes, fees, gains, and losses for that specific holding. Now we'll get into backdating entries and some dangers of backdating entries. Definitely, we are all human, and given the nature of the cash books that they are kind of produced on a monthly basis, there could be timing delays involved here. There are several reasons and main drivers for why a board admin might backdate an entry. And I guess before we even kick that off, what do we mean by backdating entries? Essentially, if you are working through your cash books, you've already completed up through October's cash books. However, you've identified or just received a statement for a September statement for your investment, and you feel, hey, this statement is dated for September. I should post the asset value changes and activity on this statement back to September. So this is an example of delayed invoicing or identification of management fees or asset value or late statements. And so that could be one reason why someone might feel they need to backdate an entry. As I mentioned before, we're all humans, so mathematical error and misclassification of accounts do occur from time to time. Additionally, sometimes the boards will receive delayed notification of estimates for members or interest not refunded. Some specific accounts, they will get delayed notification of this, which might lead them to believe that they might need to date it back to the original date of when it happened. And lastly, when you are using the double entry method to clear out your receivables or payables, it can also lead to backdating. Sometimes if they forget, in that case, in the previous example, if they forgot, when they realized in March that they hadn't relieved their accrual when they cleared out the legal expense, they might think, oh, I might need to backdate it back to January instead of posting it in the month that they realized it. So that's also another example of why backdating entries sometimes occurs on the cash books. In the next couple of slides, we'll kind of be walking through an example of how this could also happen. In this example, we have John Smith, who is a board admin for Cape Cod Retirement Board, and he has just submitted his November's cash books. After performing the trial balance check, the PARAC analyst identifies that there's a $24 million difference between what is reflected on the year-to-date trial balance provided versus what the activity shows on the reports provided for November. Upon identifying this difference, the analyst will reach out to John and question and ask, you know, if there has been any activity, or perhaps if sometimes it's just due to a timing difference of when the reports are run. If the activity reports were run prior to all entries being posted for the month of November, that trial balance would reflect different balances than what's reflected on the activity reports. But in this case, we find out that John did post some additional corrections and some additional entries to the months of August, September, and October due to late receipt of manager statements. However, he posted these after he had already submitted his October cash books, but did not think that he needed to submit the revised cash books for those months to PARAC before submitting his November cash books. Because of this, the PARAC analyst did ask him to send in his revised cash books, and as you can see here, the revised ones clear out the differences that we see. And there was no change. So even though the difference was identified in November, really that difference pertained to prior months, and really there was no change to the November reports. And it's important to note here that we do utilize the information on your cash books and track it on a monthly basis. So any changes, so that 24 million, if we didn't request updated, we never received updated reporting, that 24 million would not be incorporated in the performance calculation for the board for those months. So I guess to go on here, could this have been avoided? Yes. John could have just posted, when he received the late manager statements, he could have posted the correcting entries and additional entries simply to November's cash books with good descriptions detailing the date and the reason for the correction. By doing this, he could have avoided the need to rerun reporting for August, September, and October and send in revised cash books, because the analyst now has to review 4 months worth of cash books and re-review the 3 months because he backdated the entry. It's also, if he posted it in November's cash books when he identified or when he received the information, is also in line with generally accepted accounting principles, because their practice is to recognize the error in the period in which it was discovered. An important note here is that repetitive errors and repetitive changes to your cash books definitely undermines the credibility of future cash book submissions and may even result in an increased audit risk assessment. Okay, gone over quite a bit of information, some good tips and practices to avoid. So we're gonna insert a quick poll question here, a little quiz. Which of these practices is preferred by PARAC? You can select more than one. A, posting a correction back to its original date. B, using sub-accounts. C, clearing your prior year accounts payable management fee directly against a 20 account, otherwise known as single entry, or D, all of the above.
Okay, I'm going to launch it in just 1 second. I'll give you about 25 seconds. Should be plenty of time.
We can have the Jeopardy music next time, Natasha.
I know. I've been asking for music during this dead silence.
Yes.
Or we can just keep talking.
Yes.
All right, about 5 more seconds. Looks like just about 70% of you have voted. So maybe the rest of you are just abstaining. Okay. Thank you to everyone who participated.
Oh. Might need to review some of the slides.
Uh-oh. Why don't you go over these answers, Sarita?
Okay, so 6% voted to post a correction back to its original date. So that would be a wrong answer because we do not want to backdate entries. Using sub-accounts is a preferred method by PARAC. 50% of you answered correctly. Clearing your prior year accounts payable management fee using the single entry method is also a preferred method. And kind of the ringer here was putting in all of above, which is incorrect. It was kind of a trick question there.
Oh, you're tough. You're tough, Sarita.
Sorry. Going back to my SAT standardized testing days. They got to end sometimes.
Thank you, everyone.
Okay, so that pretty much concludes the Cashbook overview session. In summary, the Cashbook package consists of 5 reports, a year-to-date date range of your trial balance, and month-to-date date ranges of your activity reports. They are due within 4 weeks of the close of each month. Of course, there's the asterisk there is that December and year-end is a little bit different. In addition to the standard package, which is primarily your PTG or Tyler, some boards are still using Tyler reporting. This Cashbooks also include timely submission of your manager statements or pool fund worksheets, custodian and consultant reports. If these are not submitted with your Cashbooks or at the same time, then shortly after. The use of sub-accounts can be very helpful, especially if your boards are invested in numerous pool fund holdings or separate managed accounts. For clearing your accounts receivable and payables from prior year, the single entry method is preferred. And finally, for backdating and netting entries, just don't do it. And that concludes Cashbook overview for today. I guess if there are any final questions before I turn it over to Scott.
No questions at this time, Sarita. Wait,
Great.
I have one last entry. When can we start entering 2021 information?
That is a good question. My gut answer would be after you've closed out 2020, once you've rolled up your books. I'm not sure how PTG can do it if they're able to, if you enter a date of 2021, that they'll be able to kind of know this. I don't know if Karen or Scott want to add to this.
I believe PTG is entirely date driven, so
Okay.
in theory, like if you want to enter your warrants or the cash transactions, go ahead.
Mm-hmm. Okay. Okay.
I have 2 comments in response to that from attendees that say you can enter before closing. You can enter 2021 before books are closed, and not every board uses PTG.
Mm-hmm.
So
Yeah,
I guess it may vary.
The Tyler boards have to wait. They can't start entering the next year until they've closed the current year.
Okay.
Okay, and that is the last of the questions for this segment.
Okay. Well, thank you, everyone. I'm going to turn it over to Scott now. Take it away, Scott.
Thanks, Sarita.
All right. Hey, thanks, Sarita. I'm also going to start with a poll, which is going to be similar to Sarita's poll, but this is what happens when we do our presentation separately. Just finding out about where everyone's comfort level is with the annual statement. So the first choice is for the board members. If you're a board member, just hit A. The other 3 are for the retirement administrator. So either you have no idea what's going on, or you know just enough to be dangerous. And the last option there is you've done a whole bunch of these. You're really only here to listen to what Sarita was going to say. And, you know, for those people, I'd say you only have to see one more slide after this. But please choose one of those. At one point, we did have a ticking noise going on during some of these, but that just got too annoying. So it's actually better with silence than with
So
ticking.
everyone can concentrate.
Yes.
All right, everyone is pretty certain about their answers this time. Most people have already voted. So I will give about another 5 to 10 seconds for the last few people to
Okay.
submit a response. Okay. Thank you, everyone.
Okay, this isn't what I was expecting, but yeah. Okay, so at least some of you have seen annual statements before, but not too many is what it looks like. All right.
Great.
We've heard this really to a basic level, but yeah, it's parts of it will get a little confusing maybe. So yeah, those of you who have done a lot of them, here's all you need to know. There's nothing different this year. And if you do want to see the blank annual statement, that's on our website. The sequence of clicks you have to make is down the bottom there. So when I talk about certain pages, if you want to watch this later and have the blank annual statement up, that's where you can find it.
Mm-hmm. And again, Scott, if they want to download it now, they can do so. It's attached here.
Yep. Yeah, we're not going page by page like we sometimes do. We are actually sort of mirroring PTG's instructions, and so many of you have them. I mean, I think Tyler has similar instructions too, but that's why it's structured the way it is. So now looking at December, where Sarita touched a little bit, we're going to have separate slides for making the entries on the unrealized gains and losses, some interfund transfers you do at the end of the year, and the accrual entries that you have to make. So the first one on the next slide is the unrealized gains and unrealized losses. And here I'm talking about just the fixed income and the equities where you have your own separate accounts. If you have pooled funds, you're posting unrealized gains and losses every month. But for the investments where you have a separate account and it's stocks or bonds, there's just a December 31st entry for unrealized gains and losses. And you probably do your monthly posting from the custodian's one-page summary sheet that comes every month, which is fine for most things. But for this, on that summary sheet, they're netting the gains and the unrealized gains and losses. So you'll just see either a positive number or a negative number. We really prefer that you enter or post them both separately. So to find those numbers, you can either look through the custodial report, and they will be in there on their own, or if you don't want to wade through a couple hundred pages, find the schedules 3A and 4A that the custodian has sent to you. At the very bottom of each schedule, they have total increase and total decrease. So you can just post from there. Next. All right. The first interfund transfer, we're going to talk about avoiding a negative pension fund. If your pension fund is going to be negative, you're just taking money out of the pension reserve fund and throwing it in there. The part that might get a little confusing to you, if you haven't done this too many times, is if you're looking at your general ledger and the pension fund has a negative balance on the ledger, well, that's fine, because credit balances on the ledger are negative and the fund should have credit balances. So you might get a little confused where a negative ledger balance means there's going to be a positive number on the annual statement and vice versa. Worst case scenario, you do the annual statement and then you look at it and see that there's a negative pension fund. You just go back in and make one more entry transferring the money out. Your appropriation letters that you get every year do have an amount to be transferred out of the pension reserve into the pension fund. It's on the second page where they have the next 5 years of the payments way over on the right. So not every board needs to do it. It really depends on whether your appropriation payment is more or less than the benefits that are paid out during the year. And then even if the amount on the appropriation letter is not enough to get your pension fund up to zero, just throw in more money to make it zero. That's fine. And the next interfund transfer is about people who have just been sitting on your supplemental schedule for 10 years with no activity. They're no longer working. If they're not vested, so they don't have 10 years, they're not eligible for a superannuation benefit, and they're not in the middle of a drawn-out disability process, you're supposed to move those people's accounts out of the annuity savings fund transfer into the pension reserve. And so I get asked all the time, why do we have to do this? Well, it's actually in Chapter 32. It's Section 11, subsection 3. But then the follow-up question is, well, why does Chapter 32 say we have to do this? And I can only guess, this is pure speculation on my part because I wasn't around, but if you read Chapter 30, if you have a book, the book of Chapter 32, after each section, they have a history of that section. And so I looked up the history of Section 11, and that third subdivision looks like it was added in 1957. So my guess is that after Chapter 32 had been around about 20 years, people's supplemental schedules were getting kind of bloated with people who worked a year or two and then went on to some other job. And if you've ever seen a supplemental schedule from the 1950s, 60s, or 70s, you know, they're either typed or possibly handwritten. So just think about how long it would take to type out your supplemental schedule on a typewriter. I think this was done just to get a lot of the people off it and maybe save some time, make it a little easier to produce that document. But that's just my theory. All right, accounts payable. These are the things that the cost happens during the year, but you're not actually going to pay for it until the following year. So fourth quarter investment fees, your December utilities, a December legal bill. And there also might be things involving retirees who haven't been cleaned up by the end of the year. Maybe someone died in November, and although you stop their final check, you don't know who to pay that last little bit to. So that goes into the next year. Also, if you have stale checks that you have decided to put the money back into your checking account, but you're not completely writing off your books yet, they'll be sitting in accounts payable. Next. And so the receivables are the money coming in. We usually see member deductions because that final check in the last week of December, if there is a check in the last week of December, you're not actually receiving the contributions until January. The appropriations, sometimes you need one set up because the appropriation is a July 1 to June 30th fiscal year basis, and the annual statement ends on December 31st. So to get the December 31st calendar year figure equal to the July to June fiscal year, we're setting up a receivable for any money that's going to be paid January through June of the next year. And then you also might have receivables from retirees too if they were overpaid and you're getting the money back, but sometimes that takes some time. And now we're going to talk about everybody's favorite account receivable is the makeup one. You may or may not need to set one up. If you're a board who only allows members to pay in lump sums, you're not going to set up a receivable. This is for people who are paying over a number of years and a little bit at a time. It's just tracking them. Also, if you only have 1 or 2 people doing the makeups, it's probably not worth the accounting headache to set it all up and deal with it. If you start having 8 to 10 or 12 people, then I would set it up. And you should be tracking all these in Excel. So when people come into your office to ask how much they owe to pay it off, you can easily find the answer. So if you got them all in Excel, you can just get a grand total, and that's the amount to put on your books for the receivable. Now, if you're new and you've inherited a receivable for buybacks and you're not quite sure what you need to do each year, the first thing to do is lower the receivable by the payments that people made during the year, and then you're going to increase it both for any new purchases and the payment plans that are still ongoing. There's always going to be additional interest during that time. So you just have to throw that on the books as well. Next. All right. Interest due and accrued. This, we're generally talking about bonds. So if you have a separately managed bond fund, the interest that they pay, whether it's semi-annually or annually, there might be something that you're due by December 31st, but you don't get until the first quarter of the following year. To find out if you have this, look at Schedule 3A from your custodian. Interest due and accrued, it has its own column, and there's a total down the end. If you get a Schedule 1 from your custodian, you may have interest due and accrued in some of those, the short-term investment or the custodial cash and manager cash. Also, if you get a Schedule 2, you may also see it, but very few of you will see a Schedule 2. So it's generally 3A, but occasionally Schedule 1. All right, so now you look at your schedules and you see, all right, I got it. What entry am I doing? The first thing to do is get last year's interest due and accrued out of there. Now that's going to be a debit to 4820 and a credit to 1550, which will bring it to 0. And then just set up this year's number by reversing the debits and credits. And yes, it's going to be 4820, which we cover a little on the next slide, because you don't really do entries to 4820 during the year. Natasha, we can go to the next slide. 4820 is where the income gains and losses go at the end of the year when you do your closing account, or closing entries. And then the interest that gets dispersed to all the funds and the expense fund, all that comes out of 4820. So this interest due and accrued is the only entry that you're going to make right to that 4820. And the reason we use 4820 instead of 4821 is we don't want to throw off the relationship between 4821 and the schedules that are in the back that list the income. The supplemental schedule, this is the list of everyone who has an account in the annuity savings fund. Throughout the year, you do want to try to balance, not the ending balance, but the columns that are in the middle with the ins and the outs, the deductions and the refunds and transfers, just so you don't reach the end of the year and have a discrepancy and don't know where to start to look for it. As you do reach the end of the year, the deductions that are withheld from anyone's pay that was paid in that year should be on the schedule. So if your paycheck is December 30th, you want those contributions to be in the 2020 supplemental schedule. If the following paycheck is January 8th, you do not want those contributions to be on the schedule because they'll be on the 2021 schedule. Don't worry about attempting to put 3 or 4 days in December onto the 2020 schedule. It's just going to be a headache, and you don't really get anything useful from all that effort. So, and lastly, if you have set up the receivable for the makeups, you're not going to be able to match the makeup payment schedule or makeup payment amount in the schedule because the supplemental schedule is cash basis and we've changed the ledger to an accrual basis. So you just make an adjustment right at the bottom of the supplemental schedule, add in that buyback amount, and that should match the 3293 balance in your ledger. Another thing you want to make sure are equal are the retiree paid report and your the accounts dealing with the retiree payroll, the annuities paid and the pensions paid, maybe the COLA paid. And just like the supplemental schedule where you want things in the membership world to match things in the accounting world, with this, the retiree payroll, you want any entry to your books, like people returning money that was overpaid. You should also make an adjustment to the individual retiree's record to keep those things the same. And I'll go over later what happens if you haven't been doing that. Next. And now you're ready to make the annual statement. The software will do a lot for you, so we're going to cover the things that you end up typing in yourself. So starting on the next slide, we've got the investment income is broken out by the asset class of cash income, equity income, pooled fund income. You're typing those numbers in yourself. If you do receive securities litigation income during the year, if you book that to 4821, include it here using the commission recapture line. If your securities litigation, you put in 4825 miscellaneous income, do not put it here. And we want to match the closing entry in the 4821 account for the total. The balance tests, these are three comparisons that should all result in the same difference. One is just taking this year's asset ending value and subtracting the prior year's asset value. The second one is the income minus the disbursements. And the third one is the income minus the disbursements, and then you throw on the interfund transfer entries as well. So it should all be the same. So the next slide, we're going to go over the worst thing that can happen when you're trying to produce this. So yes. Well.
Sorry about that. Let's go back.
Okay. Yeah, so the balance test not working is a little like crashing your car as you're backing out of the driveway. You kind of, everything has to stop while you try figuring out what happened. Now, 4 or 5 years ago, if people had contacted me and saying that, oh, my balance tests don't work, can you help me? I probably would have said no, or I said, oh, I can try, but it's not even a 50-50 chance I'll be able to help you. But over the last few years, there's definitely been a pattern emerging of what's throwing off these balance tests. So we don't have to just bang our heads on the keyboard anymore. We can actually take some concrete steps. The first thing to do is look at your post-close trial balance and make sure every account closed correctly. So your 4,000 and 5,000 accounts should all be zero on the post-close balance. And if someone isn't, well, that's probably the problem with the balance test. The second one is that entry to 4821 where you typed in the asset class breakdown. Is there a typo on those? And what I found is if one of the balance tests is like $100,000 different than the other two, it's usually there's a typo in the 4821 figure. And the last one there, I'm not sure if your software will allow you to do this, but if you have half of one of your accounting entries to an account that isn't really set up as an account in your system, it may sort of disappear and cause the balance test to be off. All right, so the next slide is the other explanation I've found. And this is when you're doing your entries during the year, any entry that involves one of the 6 funds, 6 funds from 3293 to 3298, the annuity savings fund through the expense fund. the entry has to have a fund as both halves. You can't do the annuity savings fund and like member deductions. You can only do annuity savings fund and annuity reserve. Because if you do something like annuity reserve fund or annuity savings fund and member deductions, the closing process throws a number in there a second time. That's what causes the balance test to be off. So stick to fund transfers during the year. Don't mix and match the funds. And the ones that seem to come up more than others down the bottom there, interest not refunded, people will try to stick that right into the pension reserve fund. Don't use 4822 and the pension reserve fund. Use 4822 and 5757, the refund account. The other thing is writing off payables or receivables. If you're writing off your payable or receivable, half the entry is going to be payable or receivable. The other half should be a receipt or a disbursement account, not a fund. Back to the manual entries on the annual statement. There's a page that shows the 1 year history broken down by fund, the starting balance, the disbursements, the receipts, and the interfund transfers, and then an ending balance. So the interfund transfer is at the top. Your software will put the number in for you. At the bottom half, you are supposed to list all those entries. And so just make sure that every single one is there. You want which fund it's going into and the fund is coming out to be labeled correctly. And you match the top half there. And Schedule A, you're entering manually. So both the receivables are at the top, the payables are at the bottom. They're both organized by ledger account number. We do want every single one to be dated. So if you have the buyback receivable, put 12/31/2020 because that's the balance as of that day for the receivable. If you do have a payable or receivable that doesn't use one of the accounts listed in that section, there are blank rows underneath. They're labeled as being for investments that either bought and sold that haven't come through yet, but you can use it for other purposes too. So we'll see things like if they used cash, or if you have a receivable related to a pension that you overpaid, you can put that in the blank rows in the receivables. Next. Right, there are 7 schedules after the financial information in the front. And a lot of the info that's in the front also shows up on these schedules in the back. If you look at our sample annual statement, the one that isn't the blank one, you can see the cross references listed out there. And so who makes these schedules? Schedule 1 is cash. So you might get one from your custodian because there's custodial and manager cash. And you'll have to put your own checking and savings and money market accounts on Schedule 1. So it would either be just the board or the custodian and the board produce the Schedule 1. Schedule 2, 3, and 4 are all done by the custodian. 2 is short-term investments, 3 is fixed income, and 4 is equities. Schedules 5, 6, and 7, the board is doing probably in Excel. 5 is the pooled funds. 6 is a summary of schedules 1 through 5. And then 7 is the management fees. If your custodian sends you a Schedule 5, ignore it, and I'll tell you why later. The next. All right, I think we shocked a lot of people last year when we reviewed the annual statements and sent questions off to you. Yes, a lot of you did tell us that no one had asked them that before, and we know, because even in the past when we had done the reviews, it was December or January, and so we didn't feel like, pointed it out to you 7 or 8 months later. So last year we were able to point it out to you 1 or 2 months later. And we'll go over what we saw. I think is next a poll question. Yes. So 2 of the more common things we asked about were the supplemental schedule being off or the pensions paid being off. So the options here, just to see what happened to you guys, is first, you didn't do an annual statement. Second, nope, didn't ask me any of those. Third, yeah, you got me on one of them. And fourth is, you got me on both of these. So if you can remember back to May or June of 2020, see what we asked you.
Okay, we'll leave it open about 10 more seconds. Not as much activity for this question here. We'll leave it open for about 5
Remember
more
that far
seconds.
back.
Okay, thanks to everyone who has voted so far.
Oh, all right. Well, I guess these are people who really shouldn't be attending this because they weren't asked about one of those, but that's okay. A couple people got called on one of them. All right, so the first thing on the next slide is actually about the custodian Schedule 5. If you do only send us the custodial Schedule 5, they've combined the income gains and losses into one number. And when we do our review of comparing the schedules to the investment income page, it's really tough to verify the numbers on the investment income page. So the auditor will tell you we'd rather see the Schedule 5 with income in its own column and then the realized and unrealized gains and losses all in their own columns. The supplemental schedule will check the ending balance against the accounting. We also do take a look at the individual columns so we can, if not only the ending balance is wrong, but maybe the deductions differed or the reductions differed, we'll let you know what didn't work. And yeah, for the PTG systems, the thing I mentioned a little earlier about getting the retiree allowance paid to match the ledger if you don't do your adjustments in the individual people's records, this is where it shows up. If you look at the disbursements page 5751, there is a large number on the same row as 5751 for PTG boards, and this number is coming from the general ledger. Below that number, where it's broken into superannuation and disabilities and survivor benefits, those that come from the monthly payrolls that you produce with PTG. And you know, if you make an accounting entry that doesn't have an adjustment in someone's record, that's when these two numbers get out of balance. So. And a few other things here. The board members, we want the boards, the board makeup as of December 31st, 2020. So if someone's term ended 12/31 and you have a new board member 1/1, we want the 12/31 board member there. Please do send us the list of all your managers. We do have cases where people say to see the attached list and there's no list. And if you're in PRIT, you don't need to list a custodian. And then this last one here is very important because when we're showing up for audits now, the first year or two of the audit is going way back now, so you can't just, even in PTG, it doesn't go far enough back to just pull up a new general ledger. So if you haven't saved the post-close general ledger for the full year, then we can't get it. So just make sure that you do have one of those each and every single year. So when we show up to audit, It's easily available. And sending it to us, you can send it to us through Interchange. We've been doing it this way for a few years now. There's the address and just the set of instructions, the recipient, and you will get a confirmation saying it was successfully sent to that address if you do it right. You won't get anything from us saying that we got it, but we do plan on reviewing these timely this year as well. So you should, if we have questions, you should get them. I can't say within a month of when you send it, but it shouldn't be too long. Okay. Are there questions?
Yes, we have some questions, Scott.
Okay.
Alrighty. I was planning on sending my January cash books even without closing. Should I not?
I can take that question.
I guess I wouldn't, just to keep things in chronological order.
Hey, Scott.
Yeah.
It's Sarita. I can add to that one. Our preference would be to hold off on sending January or 2021 cash books until you've closed out your 2020 accounts, only because your January trial balance will be still be inclusive of all of your 2020 activity since you haven't closed out the account yet. So for that matter, if you do submit it, just be aware that once you close out your 2020, you'll have to resubmit any cash books for 2021 that you've already submitted.
Okay. Page 2 of annual statement difference. What is that supposed to equal? Is that supposed to match another figure on the annual statement?
Page, not quite sure what they're asking. Page 2 of the annual. It is page 2 of the balance tests. And the difference in the balance tests don't match any other figure. They just match each other.
Okay.
But that might not be page 2.
So I can put it on the screen here to see if this is what they are talking about.
Yeah, page 2 is actually the assets and liabilities.
Yes.
Oh.
So is that supposed to match another figure on the annual statement?
The total assets and the total liabilities should match.
Yes, and that page that has the 1-year history by fund, which is probably page 3, you should see the same fund balances at the end of the year on that page.
Okay. Next question. The problem with the 10-year transfer is that in PTG, if they later come back, it is a nightmare to bring them back. I guess more of a comment than a question.
Yeah, I mean, I hear that, and I know it's even worse if they aren't in PTG at all. But
okay.
yeah,
What about the 38C for AR and AP?
If I was an administrator, I wouldn't be setting up receivables and payables for 38Cs.
Should deductions from 12/31/20 payroll, which would have occurred on 1/1/21 if it wasn't a holiday, be in 2021 or 2020?
12/31 pay date, I would put in 2020. It doesn't bother me to have 53 checks or 27 biweekly checks. That's fine.
Can you please provide the checklist online? It's a great tool to make sure the annual statement is correct.
Yeah, we could. Is the old one still on there?
I can check. We may have taken it down since it had been a while.
Yeah, and when we do our review, we use an Excel sheet that I don't know if it's quite in good enough shape to share with you yet, but maybe we'll get to the point where we release it to everyone.
Okay. We won't get late. We won't get a late cash book reminder from Parax since we cannot print out the new year cash books until we close 2020. Maybe that's
Yeah, I mean that must be true. I don't know when they would actually send the late notice for your January cash books, but yeah, it's not. It won't be by April 1st, I'm sure.
Clarification, this is more of a comment, I suppose. Clarification as a board member. I do not do the annual report, but I am fully involved, as are all our board members, as they should be.
Okay, yeah, but right.
Is the transfer from PRF to PF made as a journal entry or made as we go through the closing steps of creating the annual statement?
It's a journal entry before the close.
And one more question. Comment. The 3/8Cs are for the prior year and probably the most material AR and AP.
Well, okay, I guess I thought, when I heard the question, my first thought was every single year you set up the following year's 3/8Cs as receivable and payable. I mean, that I wouldn't do. If you have like one or two boards in particular where you're waiting for a payment and you've been waiting for a couple of years, then yes, set them up as a receivable. But I wouldn't set up the 3/8Cs for the 2020 pension payments. I wouldn't set up as a receivable or payable.
Let me jump in here. I think if you know the number, you can set it up because it may be a large number. That's how I would answer that question.
Yeah, I mean, you're free to do it. It gets a little messy, right? If you overestimate or you use last year's number, but then people died. I mean, the payables would be tougher to estimate than the receivables because you would know who did or didn't die.
And the bills going out now are for last year and likewise with the payment.
Yep, yes they are, but most of our accounting is still cash based, so and you can accrue if you want, but if I was in your shoes, I would stick with just the cash basis.
Okay, and another follow-up to 3/8C. If you have set up a 3/8C receivable in 1 year, must you continue every year as your accounting method?
I would, to be consistent.
Okay. Not completely clear about this next one. Examples of interfund transfers. Maybe if you guys can talk about that.
Yeah, I mean, besides the ones that I went over, the interfund transfer you see most often is probably the annuity savings fund being transferred to the annuity reserve fund when an individual retires. Let's see, the 10-year inactives, the keeping the pension fund positive. You'll see an adjustment from the annuity savings fund to the pension reserve fund to get rid of excess interest. If you have retirees who, like a disability retiree whose date goes back 3 or 4 years into the past, they've gotten their interest on the supplemental schedule over the last 3 or 4 years, so you have to clear that out of their account. If you have,
Okay. Oh, sorry, go
yeah,
ahead.
there may or may not be one involving the military fund, but now we're getting kind of off track. But if someone leaves and they had a balance in the military fund, you're going to get it out of there via interfund transfer. You're not going to have a disbursement.
Okay, this next one uses an acronym. Maybe you guys can spell it out. It just says proper AGAP, AGAP.
It's probably
Oh,
generally accepted
Hey,
accounting
this person
principles.
corrected it. Yeah, they just typed in, yes, you're correct, Karen. Gap.
Yeah, do we follow GAAP as like a public regulatory entity? I think we try, but we don't necessarily
We
adhere
try.
to it. But
It's accrual accounting.
yeah.
What account numbers are associated with interfund transfers, i.e. from ledger number to ledger number?
Oh, 3293 to 3298.
Okay, and this last comment is just reinforcing Karen and Scott's answer to the gap. It's accrual basis. And unless there are any lingering questions, we are done with the Q&A portion. Let's see if anyone has any. Nope. Turn my camera back on. So thank you everyone for joining us today. I thought all three presentations were very informative. So thank you, Karen, Sarita, and Scott for today's presentation. As a reminder, we did record this and it will be available on the website at a later date. If you want to grab the downloads, get them now. Otherwise, again, they'll be posted to the website in the future when we post the video to the website. Board members, you'll get your credits within 1 week. And if anyone was unable to view the webinar and you are looking for credits, you can get credits for viewing the recording once we post it. So again, thank you for joining us and enjoy the rest of your day. And thank you, Scott, Sarita, and Karen. Take care, guys.
Thank you, Natasha.